Meet Sarah. Sarah is 32, a senior manager at a tech firm, and by every societal metric, she is crushing it. She has a 790 credit score, a brand new SUV in the driveway, and she just signed the papers for a beautiful $450,000 suburban home. The bank loves Sarah. They send her gold cards in the mail. They call her a preferred client. But Sarah has a secret. Despite her high salary, she feels like she's running on a treadmill that's slowly speeding up. Every time she gets a raise, the bank offers her a better loan. Every time she saves $10,000, they suggest she leverage it into a new asset. Sarah didn't realize that she wasn't a preferred client. She was a preferred product. The bank isn't a vault where your money sits safely. It's a factory that manufactures debt. And Sarah's 30-year mortgage? That's not her home. That's the bank's guaranteed revenue stream for the next 3 decades. Today, we're going inside the bank playbook. We're going to look at the 10 truths Sarah discovered that changed her life and the ghost math the banks hope you never calculate. Number 1. The amortization front load, the tenant trap. Sarah looked at her first mortgage statement. Her payment was $2,800. She expected her loan balance to drop by $2,800. Instead, it dropped by $400. Here is what the bank doesn't tell you. A 30-year mortgage is designed so the bank gets their profit first. Through a process called amortization, the interest is front-loaded. In the first 5 to 7 years, you aren't an owner. You are essentially a tenant of the bank. If Sarah sells her house in 5 years, which is the national average, she will have paid the bank nearly $140,000 in interest, while only owning a tiny sliver of the actual house. The bank took the meat and left her the bone. Truth number 2, the credit score paradox. Sarah was proud of her 790 score, but when she finally paid off her student loans in full, she expected her score to jump. Instead, it dropped. Why? Because a credit score isn't a wealth score. It's an I am a good debtor score. The bank needs to know how profitable you are. If you have no debt, the bank can't make money off you. The system is designed to punish the debt-free and reward those who keep the credit wheel spinning. A perfect score simply tells the bank, this person is excellent at paying us interest on time every single month. Number 3, fractional reserve banking, the great illusion. When Sarah deposits $10,000 into her savings, she thinks that money stays in the vault. It doesn't. Under fractional reserve banking, the bank is only required to keep a tiny fraction of that cash, sometimes as low as 0%. They take Sarah's $10,000 and lend it out 10 times over to other people at 15%, 20%, or 25% interest. They are literally creating money out of thin air using Sarah's hard work as the seed. They profit 20% on her money while paying her a measly 0.5% interest. You aren't saving money at a bank. You are giving them a nearly interest-free loan so they can go out and get rich. Number 4, the minimum payment algorithm. Sarah's gold card had a $10,000 balance after a home renovation. The bank told her, don't worry, Sarah. Your minimum payment is only $200. This is the most calculated math in the world. The minimum payment is mathematically designed to cover the interest plus a tiny, microscopic sliver of the principal. It is the death spiral. At a $200 minimum payment, Sarah would be 58 years old before that $10,000 was paid off, and she would have paid the bank over $25,000 for that one renovation. The bank isn't being flexible with your payments. They are ensuring you stay a customer for life. Number 5, the escrow arbitrage. Every month, Sarah pays extra into an escrow account for her property taxes and insurance. The bank holds this money for her. But here's the secret. The bank takes that massive pile of escrow money from millions of Sarah's and invests it in short-term markets, earning millions in interest for themselves. It's your money, paid in advance, that they use to generate their own profit before they finally pay your tax bill at the end of the year. You are giving the bank an interest-free loan every single month, and most people call it convenience. Number 6, the good debt branding campaign. The bank's marketing team is brilliant. They created 2 categories: bad debt, like gambling or consumer spending, and good debt, like student loans and mortgages. Sarah fell for it. She was told her mortgage was an investment, But an investment, by definition, puts money in your pocket. Sarah's home takes money out of her pocket every single month. Maintenance, taxes, interest, insurance. To the bank, Sarah's mortgage is a good asset for them. They rebranded your liabilities as investments, so you wouldn't feel the sting when you signed your life away. Number 7, the data prediction model. Banks know more about Sarah than her own doctor. They know when she's about to get a raise, when she's likely to get divorced, and when she's most vulnerable to a pre-approved offer. If Sarah spends $500 at a baby store, the bank's algorithm knows she's about to have a high expense year. Suddenly, she'll see offers for home equity, lines of credit, or debt consolidation. They aren't helping you through a life transition. They are identifying a customer expansion opportunity when your defenses are down. Number 8, the fees are the features. Sarah once paid $35 because her account dropped below a certain limit. She felt ashamed, like she had made a mistake. But fees aren't a penalty for a mistake. They are a core business model. Banks earn billions from overdraft and maintenance fees. These fees are specifically targeted at people who are struggling the most. The bank doesn't want you to be perfect. They want you to be just messy enough that they can trigger a fee, but not so messy that you default. It's a fine line of profitable misery. Number 9, your debt is a traded commodity. Sarah thought her relationship was with her bank, but 2 months after signing her mortgage, she got a letter, "Your loan has been sold." The bank didn't want to hold Sarah's risk. They bundled her mortgage with 1,000 others and sold it to Wall Street as a mortgage-backed security. You aren't a person to them. You are a CUSIP number, a digital asset that is traded, leveraged, and bet against by hedge funds. The bank gets a quick commission, and you are left paying a faceless corporation for the next 30 years. Number 10, the exit is sealed. Why doesn't the bank teach ghost math in school? Why don't they show you the 15-year mortgage option first? Because the system relies on your financial illiteracy. If every Sarah knew that paying just $200 extra a month could save them $150,000 in interest and shave 10 years off their sentence, the banking industry would collapse. Sarah's escape didn't happen because she got lucky or won the lottery. It happened because she stopped looking at her bank account and started looking at the system. The banks spend billions every year to make sure the ghost math stays hidden in the fine print. They want you to stay distracted by reward points while they take the equity of your life. But here's the thing, the system only works if you don't understand it. On this channel, we are building a community of people who refuse to be preferred products. We are decoding the math, exposing the traps, and taking back the keys to the American cage. If you're tired of working for the bank and ready to start working for your future, hit the subscribe button and turn on the notifications. Every week, I'm bringing you the blueprints the banks hope you never see. Remember, if you don't understand the math, you are the math. Don't let your next 30 years be someone else's asset. I'm Shekswealth, and I'll see you in the next deep dive.